Everyone, welcome to EduTap and welcome to today's Finance 360-degree session. In today's session, we are going to discuss one of the most important reports of the Reserve Bank of India, that is the Financial Stability Report, December 2025. Now, this report has been recently released by the Reserve Bank of India. So, first of all, give me a thumbs up if I am clearly audible and visible. So, do tell me if I am clearly audible and visible, okay? So, I hope everything is fine and you are able to see me clearly. Okay, so today we are going to discuss the Financial Stability Report. I will show you that what are the important points that you have to keep in mind. Why we are studying this report, we need to understand some of the important terminologies. So if you understand these terminologies, not only this session, but the coming sessions will become easier for you. As well as if you study the Financial Stability Report that will come in June, that will also be easier for you. Okay, so in today's session we will discuss the important points from the Financial Stability Report, which is one of the most important reports of the Reserve Bank of India. We will discuss the terminologies that are very important for you all to understand. So what is the CRAR, what is the LCR, what is the NIM, all these terminologies that are quite seen in the finance current affairs, these terminologies we are going to discuss in today's session with the important data point. Okay, so good morning everyone, good morning to see all of you in today's session. So let's get started, but before that, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel in which you will get the PDF of the session. Okay, and the link for the Telegram channel is provided in the description box below. So let's get started. It's live. So welcome to the session, Sarath. Welcome to the session, everyone. Good morning. Let's get started now. So RBI has released the Financial Stability Report for December 2025. This is the December 2025 issue, and the Financial Stability Report, the Reserve Bank has released the December 2025 edition of the Financial Stability Report. Remember this, that the Financial Stability Report is released twice in a year. Okay, so it is a half-yearly report. It is a half-yearly report. In 2024, it was released in June, then in December. In 2025, it was released in June and then in December. Now, next article or the next Financial Stability Report will be released in June 2026. So you can understand that this June 2026 report, it is going to be very important. This FSR, this edition will be more important for you for your RBI Grade B examination. Okay, for your RBI Grade B examination that will happen in 2026. So basically, the FSR June 2026, it will be more relevant for you to cover in the holistic manner for the RBI Grade B examination. So why are we covering the FSR for December 2025? So that you are able to understand the important points that are usually mentioned in the FSR, what is the pattern and what is the chapters that come in the Financial Stability Report, what are the terminologies that are mentioned in the Financial Stability Report year after year and issue after issue. Okay, so some of the important terminologies we are going to discuss, and some of the important concepts you are able to understand in today's session. Like the stablecoin is a term that is quite used in this Financial Stability Report, so that also we are going to discuss. So this is the idea. Yes, so the Reserve Bank released the December 2025 edition of the Financial Stability Report. So this is the recent edition that has been released by the Reserve Bank of India. Okay, now this Financial Stability Report, first of all, it is released by the subcommittee of the FSDC, or it reflects the collective assessment of the subcommittee of the FSDC. What is FSDC? It is the Financial Stability and Development Council that was constituted in 2010. The council, FSDC, this is the Financial Stability and Development Council. This is chaired by the Union Finance Minister. And the FSDC has the members, that is the Governor of the Reserve Bank of India, Chairman of SEBI, Chairman of IRDI, Chairman of PFRDA. All of these are the members of the FSDC. Even the the member of the Department of Economics. So the important members, the Secretary of the Department of Economics Survey. So all of these important members, they are the members. All of these important people, they are the members of the FSDC, Financial Stability and Development Council. Okay, Governor of RBI, Chairperson of SEBI, the Chairperson of IRDI, Chairperson of PFRDA, all of these are the members of the FSDC. Now, this Financial Stability and Development Council, it has a subcommittee. Now, this subcommittee is chaired by the Governor of the Reserve Bank of India. So, FSDC, it is chaired by the Union Finance Minister, while the subcommittee of the FSDC, it is chaired by the Governor of the Reserve Bank of India, and the members of the FSDC are also the members of the subcommittee. Okay, so basically the financial stability report, it reflects the collective assessment of the subcommittee of the FSDC. So the subcommittee of FSDC, with the collective assessment provided by the subcommittee of FSDC, that is by the inputs provided by the financial sector regulators, the inputs provided by the SEBI, the inputs provided by the IRDI, PFRDA, RBI. So inputs provided by the financial stability by the financial sector regulators. With these inputs, this financial stability report is prepared. So FSR is released by the Reserve Bank of India, and the FSR, it is the collective assessment of the subcommittee of the FSDC that has very important members. Okay, now this FSR, what does it show? The FSR, it shows the resilience, or FSR, it is the report that provides you the idea on the resilience of the Indian financial system and the risk to the financial stability. Okay, so this is about the financial stability report. Any confusion, anyone? So FSR is a half-yearly publication. It reflects a collective assessment of the subcommittee of the FSDC with inputs from all the financial sector regulators. So all the financial sector regulators, they provide inputs for this financial stability report, which shows the resilience, or which talks about the resilience of the Indian financial system and the risk to the financial stability. Now there are 3 chapters in the FSR. Macro financial risk. Macro means regarding the whole of the country. So macro financial means regarding the whole of the financial system. So what are the risks in the global economy? What is the assessment of the global economy? What are the risks to the domestic economy? What is the assessment of the domestic economy? So that is shown in the chapter 1. Then the chapter 2, it talks about the financial institutions, the scheduled commercial banks, the primary urban cooperative banks, NBFCs, insurance companies. So all these different financial institutions, they are discussed in the chapter 2, their soundness and their resilience, how resilient they are, how much capital they are maintaining, are they maintaining enough capital or not, are they having profitability or not. Okay, so the financial institutions, about them, it is discussed in chapter 2. Then chapter 3, regulatory initiatives in the financial sector. What are the initiatives that have been taken in the last 6 months for the financial sector? Okay, so all of this is covered in the financial stability report. The financial stability report has these 3 chapters. Okay, now starting with the first chapter, that is macro financial risk. So we are starting with the first chapter, in which we are going to discuss about the risk and the assessment of the global economy and the domestic economy. Okay, chalo, starting with the global economy. So global economy and the financial system have proven more resilient than anticipated since June 2025 financial stability report. So June 2025, in the June 2025 financial stability report, it was said that the global economy condition is not very good. Okay, and the future is not very good because of the so many of the external problems that are coming because of the tariffs that are being imposed. So the global economic growth condition is seemingly not very good. But what has happened, that the global economy and the financial system, they have proven more resilient than it was anticipated in the June 2025. Despite elevated policy uncertainty, there is policy uncertainty. The different governments are following different policy, and different monetary authorities of the different countries are following different policies. Okay, so there is policy uncertainty, as well as you have seen the condition of US, they are changing. Trump is changing their decision on the daily basis basically. So there is elevated policy uncertainty. The certainty is not present, the predictability is not present at the global level. The predictability is not present in the global environment. So there is uncertainty that is there. Persistent geopolitical tensions that are arising between the different countries, growing trade fragmentation, the global financial markets. So in spite of these problems, still there is resilience in the global economy and the financial system. The global financial markets remain upbeat, with equity markets, that is share market basically, in particular scaling new peaks. So the share market is still booming, and still the share prices are increasing because of the optimism about the artificial intelligence. Recently, the artificial intelligence is the new hot topic. In the RBI Grade B 2025 examination also, there was a question on artificial intelligence. The RBI has released the report, that is the free AI report has been released. So AI is the new hot topic, and there is a lot of optimism for the AI. There are a lot of investors that are investing in the AI. So you can understand that with the optimism about AI and strong corporate earnings, there is the shares market that is still booming. Okay, so there is scaling the share market is scaling new peaks, the equity market is scaling new peaks. So accordingly, International Monetary Fund has revised its 2025 global growth projection from 2.8% to 3.2%. That is, according to the IMF, in 2025 the growth was at 3.2%. That was higher than the previous projection that was provided by the IMF. So you can see that the global economy is remaining resilient even after so many of the problems that are coming up. So you need to know about the situation so that you are able to understand the current affairs, so that you are able to understand that what is going on in the global economy at this point of time and how it is affecting the domestic economy. Okay. So the apparent, see what is happening now. From this, what we have understood, that the global economy is very resilient and the financial markets are very good because the share market is booming right now. But remember this, that the apparent resilience and the risk on sentiment means the optimism of the investors. They are hiding key vulnerabilities that have global financial stability implication. So basically, there is global resilience, global economy is remaining resilient, the financial system is resilient, and the share market is booming, but it is hiding the key vulnerabilities that have global implications in the financial stability. They include, so what are these vulnerabilities that we have to discuss? The risk of a sharp market correction. So what is happening right now? The share market is booming, and it is said by many of the economists that this share market is boom is just because of the optimism that is right now. If there is any problem that arises in any of the big corporate, then this optimism can become pessimism. Then the positive sentiments can become the negative sentiments, and as soon as there are negative sentiments of the investors, the whole market can go down. So there is a risk of a sharp market correction. As well as recently you must have seen that the IPO prices were very high. The IPO prices were very high and the prices were increasing very rapidly of the shares. So it is said that the market will correct itself because the rapid increase that we have seen, it is not natural. So the market will have to correct itself. So there is risk of a sharp market correction. It might come next year, it might come after 3 years, it might come after 5 years, but it is expected that the market correction can come, and there is a risk of a sharp market correction, immediate market correction. Stretched valuation means that the IPOs in the initial public offering, IPO is the initial public offering in which the company for the first time is listing its company in the share market. Okay, so you can understand that during the IPO, the prices of the prices that the companies are putting on their shares is very high. So there is stretched valuation. It is in the market, it can be seen that the stretched valuations are there. The companies, they are stretching their valuations, they are increasing their valuation. That is not true. High and rising public debt. So public debt, the government debt is rising. So basically here you can see the public debt to GDP ratio. The public debt to GDP ratio, it is increasing. In 2021 to 24, it was around 91.8%. So if you see the data from 2012 to 2015, in this period, the public debt to GDP ratio was only 78.5%, which increased to 82.8%. That suddenly it has increased to 91.8%. Now in 2024, the latest data is that it is 94.7%. So public debt to GDP ratio is 94.7%. At the global level, if we see, the public debt to GDP is 94.7%. So if you have the GDP of 100, the public debt is 94.7. So this, by the number itself, you are able to understand, I hope, that this is a big problem because the public debt is very high and it is a very huge number. So public debt to GDP, it is now 94.7%. This is the problem, that there is high and rising public debt and the public debt is continuously increasing. The expanding role of non-bank financial intermediaries. So non-bank financial intermediaries, they are having the expansion, and they are getting more deeply interconnected with the banks. So if the NBFCs fail, if the non-banking financial intermediaries, they fail, they can affect the banking system, they can affect the banks, and if any of the bank fails, that will be a blemish on the financial system of the country. Okay, so what is happening, that at the global level, the NBFIs, the non-banking financial intermediaries, they are getting more and more interconnected with the banks. Okay, they are getting more integrated with the banks. There is risk in the private credit market and rapid growth of stable coins. There is rapid growth of stable coin that is happening. Now, what is stable coins? Okay, you must have heard this term stable coin, but what are stable coins? So I hope you have heard about the cryptocurrency. Bitcoin, Ether, Avalanche. So there are different cryptocurrencies. Now they are very volatile, like their prices keep on changing, especially the cryptocurrencies that are not traded much in, or the cryptocurrencies that are quite new. So they have very volatile price. Now stable coins, they are crypto assets issued by the private entities denominated in currencies. So stable coins, they are crypto assets, but they are denominated in currencies such as dollar or euro, that are the stable currencies. Now the stable coins that is the crypto asset, they are pegged to a specific asset or basket of assets in those currencies. So you can understand that if the stable coin is, let's say, a coin that is pegged or its value is fixed against the currency, let's say dollar, euro, or against some asset that is present in the US, let's say the real estate, or some other asset that is present in the US or Europe and such. So when the value of a crypto asset, it is fixed, it is pegged against the specific asset or basket of assets in those currencies, in the stable currencies. So this is known as stable coin. With this, what is happening? So basically remember that, let's say this crypto asset, its value is very volatile. But now if this crypto asset, its value is decided on the basis, its value is pegged, its value is fixed against the dollar, let's say, or euro. When the euro or dollar value is increasing, then the value of crypto asset is increasing. When the value of these currencies is decreasing, then the value of crypto asset is decreasing. Or let's say crypto asset is pegged against some other asset in these countries. So if the value of asset is increasing, the value of crypto asset will also increase. If the value of asset is decreasing, the value of crypto asset will also decrease. So this crypto asset is pegged. It is fixed against some asset or some currencies in these countries. So with this, what is happening, that these currencies are very stable. So that's why crypto assets are also able to maintain some stability. So these are known as stable coins. Crypto assets that are pegged to a specific asset or basket of assets in these currencies or in these countries. Got it? So I hope this is very much clear that stable coins, that's why it is named stable, because it is able to maintain some stable value. But remember this, that they are privately launched, they are privately released. That's why they are still very risky. Okay, they still have the riskiness. So this is the idea. Now, coming to the domestic economy, we have understood about the global economy, that the global economy has shown resilience, but still there are so many of the problems that are coming up. And in the future, these vulnerabilities, if they are not handled properly, they can create a lot of problem for the global economy. They are not backed by the government, they are private entities, they are issued by the private entities. They are just like the stable coin. Let's say this crypto asset is just pegging its value against dollars or euro, or against some asset in US or Europe. Okay, now crypto asset, they are fixing their value against some asset in US or European countries. So the crypto assets, they are moving in the same direction as the asset. And the asset, because US and European economies are considered more stable, so the assets, they are not very volatile. The currencies, dollar and euro, are not very volatile. That's why the crypto assets are also not considered very volatile, that are stable coins that are pegged against the dollar or euro. Chalo. Now coming to the domestic economy, growth outlook remains positive. So now we are going to discuss about India. Okay, so you have seen that recently there is very low inflation, and there is good expectations and projections for the future, that in the future also the inflation will be low. Easy financial conditions, that means there is sufficient liquidity in the financial market of our country, as well as there is stability, and the banking sector is also expanding to provide the credit. So there is easy financial conditions in our country, stable financial conditions in our country. Above normal monsoon, direct and indirect tax reforms have been taken. Direct, recently when the union budget came, in that it was informed that till 12 lakh there is no tax that or tax exemption that will be provided. Okay, so there are the tax reforms that have been taken. In the GST case also there is standardization that has happened. The ongoing expansion of digital public infrastructure with the introduction of UPI, with the introduction of the new applications. So there is the ongoing expansion of the digital public infrastructure. The digital currency is also one of that. Okay, this is also reflected in the upward. So with the low inflation, easy financial conditions, normal monsoon expectations, direct and indirect tax reforms that have been taken, so with all of these recent measures that have been taken, it is reflected in the upward revision of the India's growth forecast. So many of the organizations, the multilateral agencies like IMF, OECD, World Bank, they have revised the growth forecast upward for India. Okay, so the RBI has also revised its forecast for real GDP for 2025-26 upwards from 6.8% to 7.3%. So it is expected that India is going to grow by 7.3% in 2025-26. Chalo, India's fiscal dynamics. Now what is happening? Fiscal means related to government. Fiscal means related to government policy. So fiscal dynamics remain healthy. The government expenditure, the government receipts remain healthy, supported by sustained improvement in the quality of spending. The government expenditure is revenue expenditure and capital expenditure. Revenue expenditure is the operating expenses of the government. It is the regular expenditure of the government. These are the operating expenses of the government. Capital expenditure is the expenditure that the government is doing to increase the assets in the country or to reduce the liability of the country, to reduce its obligation. So the government has improved the quality of spending and is reducing and is focusing on reducing the operating expenses, the regular expenses, and is focusing on increasing and higher allocation for the capital expenditure so that the assets can improve in the country, assets can increase in the country, and liabilities can decrease. So basically India's fiscal dynamics, the government policy dynamics remain healthy, supported by sustained improvement in the quality of spending. The government is focusing on spending to increase the assets and to decrease the liabilities. So government has given higher allocation for capital expenditure. As well as government is also focusing on fiscal consolidation. Fiscal consolidation means reducing the debt requirement by the government by reducing the unnecessary expenditure and reducing the revenue expenditure. Okay, operating expenses, by reducing the operating expenses. This was reflected in now the S&P Global Ratings has upgraded India's sovereign rating, the India's government rating, from BBB minus to BBB in August 2025. So you can understand that with the government focusing on fiscal consolidation, reducing its debt requirement, reducing the fiscal deficit. So fiscal consolidation means that the government is focusing on reducing its fiscal deficit. That shows the borrowing requirement of the government. So government is focusing on reducing its borrowing requirement, reducing its deficit. So with the government committed to fiscal consolidation, reducing its fiscal deficit, reducing its borrowing requirement, the government is focused on higher allocation for capital expenditure. The S&P Global Ratings upgraded India's sovereign rating from BBB minus to BBB. Okay. Now, as well as the debt to GDP ratio remains at around 82%. So if you see in the comparison of the global economy, the public debt to GDP ratio is 94.7%, while in India, the public debt to GDP ratio is around 82%. That is still better than the global economy. Okay. Now, current account deficit. So I hope you know that in the balance of payment, which records all of the transactions of India with the rest of the world. So in the balance of payment, we have the current account and we have the capital account. We have the current account and capital account. In the current account, we have trade in goods. So all the trade in goods, all the trade in services that is happening between India and the rest of the world, and the transfer payments like the remittances that is coming from abroad, or the remittances that is going from India to abroad. So all the remittances, all the gifts, they come under transfer payment. So current account, it includes trade in goods, trade in services, and transfer payment. Now what is happening that the current account is in deficit. The current account is in deficit. That means we are paying more than what we are receiving. We are paying more than what we are receiving. We are receiving, let's say, $100 billion while we are paying $500 million. So there is the current account deficit of $400 million, let's say. So this is the idea. That means there is the current account deficit. So in the current account, we have the trade in goods, trade in goods, we have the trade in services, and we have the transfer payment. Now the current account deficit has increased from 0.3% of GDP to 1.3% of the GDP from quarter 1 to quarter 2. So in 6 months you can understand that there is the increase in the current account deficit. The current account deficit has increased from 0.3% to 1.3% of GDP. That is because of trade in goods. We are importing more and we are exporting less. With less exports we are getting less money. With more imports we have to pay more. Okay. So we are exporting less, we are importing more, so we have to pay more. So current account deficit is increasing because of the deficit in trade in goods. Now it remains eminently manageable. We are still able to manage the current account deficit because of the trade in services and the transfer payments, because of the remittances that we are receiving from the other countries, because of the remittances that we are receiving from the non-resident Indians that are living abroad and they are sending money to India. So we are receiving remittances from abroad, from the NRIs and such, as well as the trade in services is also buoyant. It is also good. We are able to export more of the services. So we are exporting more of the services for which we are getting good amount. So current account deficit has increased from 0.3% of GDP to 1.3% of the GDP, but it is still manageable because of the good services, because of the good service export and inward remittances that we have received. Okay, so this is the idea. Now coming to the chapter 2. Any confusion in chapter 1? Any confusion in the chapter 1? So we have discussed about the global economy, about the domestic economy. Now we are going to discuss about the financial institutions, soundness and resilience. So basically, the Indian banking sector continued to remain robust with strong capital and liquidity buffers. Okay, so Indian banking system, that is the scheduled commercial banks, the primary urban cooperative banks, they are still very resilient. Okay, they remain robust with strong capital and liquidity buffers. So let's start with the idea, with the data. Chalo, scheduled commercial banks. So scheduled commercial banks asset quality continued to improve while they maintained stable capital. Let's see the data. So here you can see the data for the scheduled commercial banks. So here the 10-year average is given and here is the recent data. You can see that the best is green and the worst is the red. Okay. Now the credit and deposit. The credit growth has happened. In the credit you can see that the 10-year average is 10.6% and the current percentage, the credit growth is 11%. Okay, so that means there is the growth of the credit that is happening at a good percentage. While in the deposit, the 10-year average is 10.1% while the current data is 9.8. So why do you think that deposit growth has decreased? And here you can see from 11.2% of deposit growth, now there is only 9.8% of deposit growth. So deposit growth is in orange zone. Is it in the bad kind of zone? So why the deposit growth has decreased? Anyone? Because there are more investment opportunities that are being provided. In the financial market, in the gold, many of the people are investing and they are saving the money through different means. Okay, so here you can see that the credit growth is good, but the deposit growth is declining. And the 10-year average was 10.1% while the current percentage is 9.8%. So there is the deposit growth that the banks have to focus on. Okay, so that they can have funds, because through the deposits the banks are getting the money to provide the credit. Okay, now asset quality and provisioning. Asset quality basically means, see, if the banks, they are providing loan to the customers, banks are earning what the banks are earning. What do you think? So if the banks are providing loans to the customers, the banks are providing loan for free? No, the banks will earn interest on this loan. So that means banks are earning the returns on the loan. So this loan is the asset for the bank. This loan is the asset for the bank on which the bank is earning the interest. So loans are asset for the bank because on the loans the bank earn the interest, or we can say the returns. Okay, so these assets, now all these assets, they have some risk. Okay, that means these assets, the loans, they can become non-performing asset. They can become NPA, that is non-performing asset. What if the customer do not return the loan? What if the customers stop the interest payments and do not return the loan? So this can happen. So there is gross non-performing asset, total non-performing asset ratio. The 10-year average is 6.9%, while the current percentage is 2.2% in September 2025. So you can understand that there is a huge dip that has come in the gross non-performing asset. So that is a good news for the banking system, because the gross non-performing asset, the non-performing assets are decreasing. Okay, the non-performing assets are decreasing. Now coming to the net non-performing asset, the net non-performing asset. So net non-performing asset is basically gross non-performing asset minus the provisions that the bank has maintained. So basically when the bank is giving the loan, the bank know that some of the loans might be defaulted. Some of the loans, some of the money might not come back. So the banks, they do maintain the provisions by themselves. Okay. So gross non-performing asset, let's say it is 100, the provisions that are maintained. So net non-performing asset is equal to gross non-performing asset minus the provisions that the bank is maintaining. Okay, so this is the net non-performing asset. So the 10-year average is 2.9%, while the current is 0.5%. So you can understand that the net non-performing asset has also decreased, and it is also in a good range in comparison to the 10-year average. Now slippage ratio, it is basically the new NPAs that are created in this current financial year. So the 10-year average is 1.3%, while the current percentage is 0.3. PCR, provisioning coverage ratio. Provisioning coverage ratio basically means that how many provisions the bank is maintaining against the NPAs, against the gross non-performing assets. So the 10-year average was 62.4%. That means against the gross non-performing asset of 100, the provisions was 62.4. Now the recent data is 76. That means 76% is the provisioning coverage ratio against the gross non-performing asset of 100. The banks are maintaining 76 of the provisions. That are good number of provisions the bank is maintaining. Chalo. So credit and deposit, asset quality and provisioning. Any confusion in any of the term? Gross non-performing asset are the total non-performing assets. Net non-performing assets are the non-performing assets after deducting the provisions, after taking out the provisions. Then whatever NPAs are left, that is net non-performing asset. Slippage ratio is the new NPAs that is created in a financial year, and the PCR is the provisioning coverage ratio, that is the provisions that is maintained against the gross non-performing asset. Now coming to the profitability, NIM is the net interest margin. That is basically the interest margin that the banks have. Now for the loans, the banks are getting the interest, while for the deposits, the bank has to pay the interest. Now which will be higher? The interest that is paid for the deposits or the interest that is taken on the loans? The bank, which interest will be higher? The interest on the loans or the interest on the deposits? What do you think? Yes, very good. The interest on the loans will be higher. The interest on the loan will be higher than the interest on the deposit. Okay. So this is the idea that net interest margin, the net interest margin is basically the interest on the loans minus the interest on the deposits. Okay. So this is the net interest margin. The 10-year average is 3.3%. The current is also the same. The return on assets, the bank is providing the assets. Okay. The bank has different investments, different assets in the form of investment. The bank is providing the loan. The loan is also the asset for the bank. So bank has different assets. The loans that the bank is providing, the investment that the bank is doing. So bank also buys the shares and such. So return on asset 10-year average was 0.6%, while the current return on asset is 1.3%. That is a very good percentage. That means there are higher returns that the banks are getting. Return on equity, that is if you have purchased the shares of a bank, how much equity, how much dividend you are getting, how much return you are getting on equity, how much returns the shareholders are getting on equity. So it was 6.1%. 10-year average. Now it is 12.5%. Again, the returns on equity is also good. Coming to the capital, how much capital the banks are maintaining. So see, the CRAR, it is the capital to risk weighted asset ratio. Like I've told you that the assets, they are the loans for the bank. Okay, the loans are the assets. On the loans, the banks are earning the interest, but these loans also have some risk. The risk, there is a risk weight that is attached with the loan. There is a risk weight that is attached with the loan. Okay. So let me just a second. Okay. So there is some risk weight that is attached with the loans. Let's say the loan is given to a big corporate. The loan is given to micro, small and medium enterprise. The loan is given to the government, to the central government. Which loan will have the least of the risk weight? Which loan will have the least of the risk weight? Shiva, it was NPA. I will explain it again. Yes. The government has the least of the risk weight. Okay. Then after government, the corporates, let's say corporates have the risk weight of 20%. The MSMEs, let's say they have the risk weight of 70%. So risk weight is attached to the assets, to the loans. Against these risk weighted assets, there is capital that the banks have to maintain. Okay. So that is the CRAR. That is against the risk weighted assets, against the risk weighted loans, the bank has to maintain the capital. The bank has to maintain the capital. Now the CRAR is maintained in the form of tier 1 capital as well as the tier 2 capital. Tier 1 capital is known as the liquid capital. Liquid capital that can be used when there is any distress that is coming in the bank. Okay, so in case of distress, the tier 1 is the liquid capital that can be used. In the tier 1 capital, there is common equity tier 1 capital. There is common equity tier 1 capital. That is the most liquid capital that the bank can have. This is the most liquid capital that the bank can have. Then in the tier 2, this is the kind of capital that is not very liquid, like the assets of the bank, the building of the bank and such. Okay, so CRAR, this is the capital that the bank is maintaining against the risk weighted asset. Now the capital is maintained in the form of tier 1 capital and tier 2 capital. Tier 1 capital is the liquid capital that the bank can use during the distress situation to handle the distress. So tier 1 capital is divided into common equity tier 1 capital and additional tier 1 capital. Common equity tier 1 capital is the most liquid capital that the bank has. Okay. Tier 2 capital is not so liquid. So common equity tier 1 capital ratio, it was 12.5% as the 10-year average, while currently it is 14.8%. That is higher. So bank is maintaining more of the liquid capital so that it can handle the distress situation. CRAR, the 10-year average is 15.4, while currently the bank is maintaining 17.2. So that is also good, that the bank is maintaining more of the capital against its risk-weighted asset to handle the distress. Chalo. Now slippage ratio. So basically the new NPAs, the new non-performing assets that have the new NPAs that is created in a year. The new non-performing assets that are created in the year. So that is slippage ratio. That is out of the standard assets, out of the standard loans, how many of the loans have converted into NPAs in a year. So that is shown by slippage ratio. Chalo, any confusion, anyone in the terminologies? Chalo. You will get the PDF. Okay. You can see the screen. The rest of the screen is visible, I hope. So here it is 17.2%, 17.2%. Okay. Chalo. Now coming to the liquidity coverage ratio. Liquidity coverage ratio here. See LCR. What is the liquidity coverage ratio? Liquidity coverage ratio, what is this? See, liquidity coverage ratio shows that if there is the outflow, if the depositors have deposited their money, they will ask for the money back, right? They are not going to give the money to the banks. They are not going to just like grant the money or just like what do we call it? They are not just going to keep the money with the banks. They will take the money back whenever they require. So depositors, they do ask for their money back. So let's say there is the outflow. The depositors are coming to ask for their money, and the outflow, the net outflow, the net cash outflow that the banks are expecting in the 30 days is 100. Now, if the bank is expecting that in the next 30 days, the net cash outflow will be 100 rupees. So how much money do you think that the bank should be maintaining? Minimum. How much money do you think that the bank should be maintaining? How much money do you think that the bank should be maintaining? It is 100 rupees at least. Okay. So if the net cash outflow is, like if the net cash outflows in the coming 30 days is expected at 100, the bank should at least maintain 100 with themselves. The bank should at least maintain 100 with themselves. So bank is currently maintaining 131.7. So here you can see that the bank is maintaining way higher liquid assets with itself against the total net cash outflows over the next 30 calendar days. So LCR ratio, it is the liquidity coverage ratio. It shows us that against the net outflows, against the total net cash outflows over the next 30 calendar days, the bank should be maintaining the high quality liquid asset in the form of cash, in the form of gold, in the form of government securities. So the high quality liquid asset should be maintained with the bank. So if we are expecting that in the next 30 days, the cash outflows will be 100. So the bank should be maintaining at least 100 with itself so that it can pay to the depositors. And the bank should be maintaining more than 100 so that the bank has enough of the funds to pay to the depositors even if the depositors are asking for more money. Got it? I hope this is clear. Yes. So liquidity coverage ratio, this shows the value of high quality liquid assets that the bank has to maintain with itself against the total net cash outflows over the next 30 calendar days. So if the bank is expecting that over the next 30 calendar days, 100 rupees will be the net cash outflow. So the bank should maintaining at least 100 rupees. The banks are maintaining 131.7 rupees right now, so that the banks are maintaining more to pay to the depositors if the depositors come to ask for the money. Now coming to the macro stress test. So these are the recent data that we have seen. Now coming to the macro stress test, this assesses the resilience of the scheduled commercial bank to withstand the adverse macroeconomic shock. So a time period is taken, 1.5 year of horizon is taken. 1.5 years of horizon time period is taken in which a test is done. Okay, so it is seen that after 1.5 years, what will be the capital that the banks will be maintaining? What will be the resilience of the banks? Okay, so this is the macro stress test. There are 3 situations that are taken. In the baseline situation, that means in the normal situation, how the bank's condition will be, how much capital the banks will be holding after 1.5 years. Then in an adverse scenario 1, in a bad scenario 1, what will be the capital that the banks will be maintaining after 1.5 years? Okay, adverse scenario 2, if there is adverse scenario 2, then after 1.5 years, how much capital the banks will be able to maintain. Okay, so what is baseline scenario? Means the normal scenario, normal condition, the condition like this that we are having right now. Adverse scenario 1 means this scenario assumed that a slowdown has happened in the global growth on account of the heightened economic uncertainty, the policy uncertainty, as well as lingering geopolitical conflicts. So if the global slowdown happens, so how much effect will come on the GDP growth? There will be effect on the GDP growth, there will be effect on the inflation. So how much capital the banks will be maintaining in this adverse scenario 1. Okay, so this is the idea that if there is adverse scenario 1, that means there is slowdown in the global growth because of the heightened economic uncertainty, because of the geopolitical fragmentation, because of the geopolitical conflicts. If there is slowdown in the global growth, then the GDP growth of India will decrease, inflation might increase. In this situation, in this adverse situation, how much capital the bank will be able to hold. Adverse scenario 2 shows that if there is global trade uncertainties because of the decisions taken by Trump recently, because of the announcements done by US, so there is global trade uncertainties that are arising. Unfavorable trade deals and higher trade gap would result in a sharp dent in the domestic GDP growth. Further capital outflows might happen because if there is a lot of uncertainty, then the investors, they want to keep dollars, euro, that is stable currency, rather than holding the money in rupees. So there might be capital outflows. The foreign investors might be taking out the money from the Indian financial market. Currency depreciation can happen. Our rupee can lose its value. Okay, and supply dislocations can happen. Supply chain disruptions can come. So in the adverse scenario 2, because of the global trade uncertainties, what will be the effect on the banks and how much capital the banks will be maintaining in the adverse scenario 2? Chalo. So here is the data. Here you can see that currently this data was taken for around 40 scheduled commercial banks. Okay, so for some of the selected scheduled commercial banks, for them the data has been taken, because when the survey happens or when the test happens, all the scheduled commercial banks, on that the test cannot happen, so a sample is selected for the test. So macro stress test happened on a selected few scheduled commercial banks. So it is seen that in the baseline scenario, the scheduled commercial banks will be able to hold good CRAR, good capital to risk weighted asset ratio. Okay, the bank will be able to hold good CRAR near to the current level. If in case of adverse scenario 1, if the adverse scenario 1 happens, then also the bank will be able to maintain good CRAR. In adverse scenario 2 also, the bank will be able to maintain the CRAR. The minimum CRAR requirement as per the Reserve Bank of India is 9%. 9% plus 2.5% of capital conservation buffers. Plus 2.5% of capital conservation buffer. So this is the minimum CRAR that the bank should be maintaining, and this is the capital conservation buffer, additional buffers that the bank should be maintaining. So if we add this up, it is 11.5%. You can understand that even in the adverse scenario 2, even in the worst of the situation, the banks will be able to maintain more than the required CRAR, adding the buffers also. Got it? Is this clear? That even in the worst scenario, the banks will be able to maintain the CRAR, the capital. Now, primary urban cooperative banks, the credit growth for all the urban cooperative banks is around 7.4%. The gross non-performing asset, if we compare the data of September 2024 to September 2025, so you can see that the gross non-performing assets have reduced to 7.6%, and the net non-performing asset has reduced to 2.5%. So gross non-performing asset has reduced and net non-performing asset has reduced in 1 year time horizon, in 1 year period. Now CRAR, the capital that the banks are maintaining against the risk-weighted assets, so it is 18%. That is the capital that the primary urban cooperative banks are maintaining against the risk-weighted asset. Provisioning coverage ratio is also good. It is around 69.2%. This is higher than the September 2024. So from September 2024 to September 2025, the provisioning coverage ratio has also increased in a 1 year horizon. Then the net interest margin, that is the interest that is earned on the loans minus the interest that is paid on the deposits. So the net interest margin has reduced from the September level. So this is the data we have already discussed, that what is the gross non-performing asset, what is the net non-performing asset. So this is just the data now. Moving forward to the NBFCs. So credit growth, NBFC upper layer plus middle layer. See, NBFCs are divided into 4 layers. Anyone knows that what are the 4 layers? NBFCs are divided into 4 layers. The base layer, middle layer, upper layer and top layer. The higher you go, the more riskier the NBFCs are, the more regulations that has to be followed. So higher you go, the bigger the NBFC, the more riskier the NBFC is, and there are more regulations that has to be followed. Okay, so upper layer and middle layer, they combined had the credit growth of 21.3%. Okay, the asset quality, you can see that the gross non-performing assets have reduced from the previous March period to currently. In the agriculture, industry sector also, in the services also, there's slight increase. But if we see from September, there is decrease. Okay, so the highest, first of all, sectoral asset quality, the highest assets is from industry. The highest loans given by NBFC, by the middle layer and upper layer. So NBFCs are giving the highest loans to the industry. Then there are retail loans that is given to the individuals. Okay, so in the industry, you can see that there is the decrease in the gross non-performing asset, as well as in the retail loans also we can see that slight decrease has happened in the gross non-performing asset. Now, NBFCs remain robust, supported by strong capital buffers, solid earnings and improving asset quality in the major areas. The loans are provided to industries and retail loans. The highest loans are provided in these areas, and in these areas we can see that the gross non-performing asset have reduced. Now, capital ratios. So capital risk weighted asset ratio, this is for the upper layer. So you can understand that the CRAR is 18.4%, while the tier 1 ratio or tier 1 capital, that is the most liquid capital, is 20.3%. Now here, I have said opposite. The CRAR is 20.3% and the tier 1 ratio, that is the that is the most liquid capital, the tier 1 capital is 18.4%. This is for upper layer. For middle layer, the CRAR is 27.9%, while the tier 1 capital, that is the most liquid capital, is 26.1%. So you can understand that the banks are maintaining very high, the NBFCs are maintaining good CRAR, they are maintaining good capital to risk weighted asset ratio, as well as they are maintaining good tier 1 capital. That is the liquid capital to handle the distress. So this is the idea. So this is for the upper layer, this is for the middle layer, and this was for combined middle layer and upper layer. Middle layer and upper layer. Okay. So NBFCs remain robust, supported by strong capital buffers. The bank has, NBFCs have strong capital buffers, solid earnings, and improving asset quality. Now, coming to the insurance sector. So this is the last part that we have come to. So insurance sector total premium income grew to 11.9 lakh crore from 8.3 lakh crore, reflecting consistent market expansion that is happening. However, the total insurance premium masks a significant growth moderation. So the insurance premiums are growing, but by a smaller rate. So the growth is happening, but the growth rate has moderated. Okay, so insurance premiums are growing, but by a lesser rate. Why is it so? Because after the COVID-19, suddenly the people realize that, okay, if a pandemic comes, we will require to have some insurance, some health insurance, because otherwise the hospital bills will be very heavy to handle. So many of the people, they started to take insurance. They started to take the insurance, the health insurance, the life insurance and such after COVID. So suddenly after COVID, there was a boom in insurance market and the insurance premiums were rapidly increasing. But now the deceleration or the growth that is happening, but at a lesser rate. So this deceleration in the growth rate suggests that the post-COVID demand surge for risk mitigation may have subsided. Now the people are coming to the people have started to live their normal lives again, and the people have forgotten and the people are not considering much of the risk now. Okay, so the post-COVID demand surge for risk mitigation may have subsided now. So risk premiums are growing, but by a moderated rate now. There is growth moderation that has happened. Growth is happening, but by a lesser rate. And this is because that after the COVID, there was a demand surge that happened. Insurance premiums, the insurance purchase increased rapidly because of the fear of the COVID, because of the fear that what will happen if I die, what will happen to my family. So life insurance, health insurance were being purchased rapidly and huge premiums were given. But now the demand surge for risk mitigation may have subsided. So that's why the insurance premiums are growing, but by a lesser percentage. Overall, the insurance sector continues to display balance sheet resilience, supported by adequate capital buffers that the insurance companies are maintaining. Steady capital creation, that means the insurance premiums are increasing even though the growth is moderated, but still the insurance companies are able to collect the capital, collect the money. Solvency ratios, so basically the insurance companies, they have to maintain the solvency ratio of 150. Of 150%. Okay, that means against their liabilities, let's say in the future they might have to pay 100 rupees as the insurance coverage. So they should maintain at least 150 as the asset. If they have the liabilities of 100, they should maintain the asset of 150. So that is the solvency ratio, and the solvency ratios, it remained above the prescribed regulatory threshold of 150. Okay, so IRDI, that is the Insurance Regulatory and Development Authority of India, IRDI has said that solvency ratio should be 150. Against the liabilities of the insurance company, they should maintain the assets of 150. So against the liability of 100, 150 should be asset. And the solvency ratio that remain above the prescribed regulatory threshold by the insurance companies, they are maintaining more than the solvency ratio. GST exemption introduced in September 2025. So this is the important point, that GST exemption has been introduced in September 2025 for all individual life and individual health insurance policies. This is likely to strengthen the sector's premium generation trajectory because the GST exemption has been given. So if there is no tax, that means the price will reduce. Before the price was 100, 90 for the premium and 10 for GST. But now this GST will not have to be paid. So 90 rupees, that is the premiums have become cheaper without GST. Now, chapter 3, that is regulatory initiatives in the financial sector. So basically, there are different regulatory initiatives that have been taken in the past 6 months, and most of these regulatory initiatives we have already discussed in the Finance 360-degree session, like the investment in alternative investment funds, direction of co-lending, the non-fund based credit facilities. This also we have discussed in detail. The framework for responsible and ethical enablement of artificial intelligence, the free AI report, this we have discussed. We have discussed about the scheme that the RBI has launched for 1 year so that the unclaimed deposits can be returned to the depositors, okay, and the banks can take the efforts to open the inoperative accounts or to reoperate the inoperative accounts and such. Know your customer amendments, all of these steps that have been taken in the past 6 months, they have been discussed if they were important, okay, and you can still read. If you want to read, you can read through the document also for the financial stability report. Now, any confusion till now? RBI releases the Financial Stability Report December 2025. So today the RBI has released the December 2025 edition of the Financial Stability Report. So it has been released recently on 31st December 2025. So we have discussed the important points. Now the highlights are that the global economy has been resilient, supported by the fiscal measures, by the policies of the government, front-loaded trade, that means there is more trade that is happening because of the optimism, and strong AI-related investment. However, downside risk persists due to uncertainty, high public debt, risk of disorderly market correction. Market correction can happen. Global financial markets appear strong on the surface, but there is vulnerabilities that are present. Sharp rise in equities have happened. The share prices are rising very rapidly. That is a problem because the market correction can happen. Okay. So this also we have discussed. Despite an uncertain, challenging global economic backdrop, Indian economy continues to grow strongly, underpinned by the robust domestic demand. See why Trump is imposing such huge tariffs. So why still India is growing? Why the demand is not falling a lot? Because we have huge population that has huge domestic demand. Okay. So basically, even if the US decreases its demand for our export products, India has a huge population with a huge demand. So the domestic demand is able to make India remain stable. Okay. So we have huge domestic demand because of which we are able to handle the outside pressure to a limit. Okay. Benign inflation, the inflation has reduced. Prudent macroeconomic policies have been brought by the RBI, by the government. The domestic financial system remains robust. We have seen that the scheduled commercial bank, they are sound, strong capital and liquidity buffers are there. The macro stress test that is done for a coming horizon of 1.5 years. In this, we have seen that in the baseline situation, in the adverse scenario 1, adverse scenario 2, the banks will be able to maintain good capital buffers, as well as stress test that is done for the mutual funds clearing corporation. It is also showing that the resilience will be maintained in the mutual funds and clearing corporation. NBFC's data also shows that the NBFCs are robust. Insurance sector continues to display balance sheet resilience. Consolidated solvency ratio remained above the minimum threshold limit of 150. So the solvency ratio, the insurance companies are maintaining higher than the minimum threshold. So this is it for today. And now, any confusion? So this is the first question. I hope you will be easily able to answer this question. The PDF will be provided to you. The PDF will be provided to you in the description box in the Telegram channel. The PDF will be provided to you in the Telegram channel. And the link for the Telegram channel is provided in the description box below. Okay, so you will get the PDF within 24 hours. Tomorrow is Sunday, so maybe it might be delayed, but you will get the PDF in the Telegram channel. The link is provided for the Telegram channel in the description box below. Okay, so this is the idea. Now this is the first question. I hope you will be able to answer this question. And this is the homework question for all of you. So do try to answer this question. And this is the second question. This is another homework question. So do try to answer this question. As per the recent Financial Stability Report, December 2025, which of the following statements correctly reflect India's fiscal position? So this is another homework question. So do try to answer this. Chalo. Thank you everyone. Thank you for joining. I hope you enjoyed the session. And thank you everyone. Any confusion, anyone? All clear? See, top layer, it usually remains empty. Top layer, it usually remains empty. Okay. The current scenario, I will have to check, but top layer, it is said that it is usually remains empty. Okay. So in the base layer, the small NBFCs come into the base layer, the NBFCs that are non-deposit taking, that have the asset size of less than 1000 crore. So they come in base layer. Then the bigger NBFCs like the deposit taking NBFCs as well as the non-deposit taking NBFC that have the asset size of 1000 crores or more than 1000 crore, they come in middle layer, as well as on the basis of the activity also some of the NBFCs can come in the middle layer. Then there is the upper layer, the top 10 NBFCs on the basis of the asset size, they come in the upper layer, as well as RBI can decide on the basis of the methodology and the risk assessment that more NBFCs can also come in the upper layer. Top layer usually remains empty. I will check that if there is any recent NBFC that has come into top layer, but usually the top layer remains empty. Okay, you can leave the comment down below and I will see and I will check. Yes, this is the first video of the Finance 360-degree sessions for 2026. I hope you enjoyed the video, and now we will meet in the next session. That will be on Thursday. So Thursday next week at 10 a.m. I'm going to bring a very, very important topic on the next Thursday, 10 a.m. Okay. So Thursday, 10 a.m. Let's meet then. So next Thursday, 10 a.m. I'm going to bring a very important topic that will help in the preparation of NABARD, that will help in the preparation of RBI also. So thank you everyone. Thank you for joining, and thank you everyone.